Okay, everybody, what I'd first like us to do is just to review the topic of a lease. Okay, so the first thing that we got to do is determine, is that lease a operating lease or a finance lease? Okay, so again, here's our criteria. Now, follow along with me. Go to page 18.9, sorry, not 18.9. Go to page 1300. And follow along with me here, A18.9. Okay. So this question here, it says there's a couple things. If we look at point one, or question one, the residual values are not bargain purchase options. Okay, so your residual value is your salvage value. Okay, that has nothing to do with a bargain purchase option. Because in this scenario here, the residual value is $15,000 at the end of the first term and $5,000 at the end of the second term. Okay, so that's that's salvage value, estimated salvage value. A bargain purchase option would be valued at $1. Okay, that's a bargain. So we don't have a bargain purchase option. Okay. Now it says, what evidence would be collected to support the conclusion that the residual value is not a bargain purchase option? There's various publications that we could go to. We could just open up the internet and find out what we could expect something to be in 5 years. Okay. Now, the leasee doesn't own this truck. Why is it an asset on the balance sheet? Okay. Well, we don't know it's an asset on the balance sheet yet because we haven't tested it. Okay. Once we test it, then we will know if it'll be an asset on the balance sheet. Okay, so because we still got to test in our own mind, is this a finance lease or an operating lease? Again, a finance lease is going to go on the balance sheet. Okay, calculate the present value of the minimum lease payments. Okay, so this is now what we're getting into, because on the exam it's going to say, okay, here's your lease. Determine, is it an operating lease or a finance lease? Now make your journal entries for the next 2 years. Okay. So again, that's the first thing we got to do. Is this a finance lease or an operating lease? So let's look at the scenario here. Lease payments are $12,500 per year, each April 1st. Okay. Now, the lease may be renewed at the option of the lessor for a further 5 years for $3,600 a year. Okay, fine. The second lease term payments include $1,200 for maintenance and expenses. The initial lease term includes $1,200 for lease payments, maintenance expenses, but there's no maintenance built into the second lease payment. The asset has a useful life of 10 years and a fair value of $70,000 at the end of those 10 years. The interest rate implicit in the lease is 7%. Okay, so first of all, let's figure out, is this going to go on our balance sheet? Now, it's going to go on our balance sheet if it's a finance lease. So is there a bargain purchase option? No. What's the useful life? So how much are we going to use this for? We are going to, our first lease is for how many years? 4 years. Okay, so 0.2, 4 years, plus we have an option. The lessor has an option of another 5 years. 9 years, useful life is 10, the economic life is 10. As a result, that's at 90% already. Okay, so we could say, yeah, we're using it for the majority of its economic life. Okay. So that would be a finance lease, okay? Now, we got to do part 3 anyways. Why? Because it says in our question, calculate the present value of the minimum lease payments. Well, let's just say that this might have been 60%. We still would have had to go to step 3 to figure out, is this a operating or finance lease? So let's look at all our inflows or outflows of cash. So first of all, we're paying $12,500 a year, but in that $12,500 is $1,200 for maintenance expenses. We don't include that maintenance, okay? So what we are going to do, the present value of the actual lease payment, not including the maintenance, is $11,300. Okay, that's for the first term. Now the second term, okay, is going to be $3,600 per year. I guess we got to figure out the present value times P over, okay, and it's payable on the first of the year. So the present value of an annuity due, we're going to have to use the rate that's implicit in the lease of 7%. And we're going to have it at 4 years. Oops. 4 years. Again, we're going to go to our present value table. Now, the 3,600. Okay. Again, remember when we have an option for this lease, okay? We've got to figure out the present value of an annuity due, 7%, okay? And we're going to use our new lease term of, in this case, a further 5 years. But then we also got to multiply it by the present value of a future payment, which we're going to take it back. This has got to equal 7%, 4 years. Okay. Again, that's going to equal this. Okay. Now, lastly, we have a guaranteed residual value. Do we use 15,000 or do we use 5,000? We are going to use 5,000. Okay, and the reason why is because the lease term is at the option of the lessor. Okay, so the lessor may lock us in. So 5,000 times DF 7%, and in this case it's 9 years. Okay, so we've got to figure out the present values of each. Okay, so 11,300 times what? Well, we got to go to our future value table. Okay, so we're going to go to the future value table of an annuity due. That's on page 1679. Okay, so we're at 7% at 4 years. 3.62432. Now, we could calculate that out, okay? What would it be? 40,955. What about the lease renewal option? Okay, well, again, now we got to do two different calculations. 3,600 times, well, let's go back to our present value table on page 1679. This time it's 7% at 5 years. 4.54595. Okay. Now, don't forget this part, okay? Now we're going to page, what is it, 1675, 7% at 4 years. Okay, 0.76290. Okay. And then lastly, again, we're going to stay on page 1675, 7% at 9 years, 0.54393. Now, let's get an answer. Just gonna multiply these up. Okay, so we've already got the first term's present value. Okay, now we'll get the second lease term. 3,600 times 4.54595 is 16,365. Okay. Now, it's not, I got a wrong number here. The textbook says 12,049. Why is that? I must have used the wrong number. Okay, so I'm just going to go double check. 7% at 4 years. 7%, 4 years. 0.762. 0.76290. Okay, that's right. Now we'll go back to the other chart. Okay, and this is going to be 7% at 5 years. 4.387. I don't even know why I use that other number, but I use the wrong number. 7% at 5 years. 4.38721. Where did this 4.545 come from? I have no idea. 4. Oh, I used 5% at 5 years. That's obviously that's going to be wrong. I needed 7%. I need 7% at 5 years, not 5% at 5 years. Okay, so that should get us the required number. One more time, 3,600 times 4.38721 times 0.76290. And we get 12,049. Okay, and lastly, the residual values, present value is $5,000 times 0.54393, and we get 2,720. Okay, so now we're going to add up all three totals. And what are we going to get? 55,724. Okay, so it's this, this, and this, giving us 55,724. Now, again, we already know that it's a finance lease, but if we didn't, no problem. Okay, we could still go and compare that 55,724, okay, to the current value, or the current fair market value. Now, in this case, I'm just going back to the textbook, the current fair market value is $70,000. Okay, so if we just took 55,724 divided by 70,000, 55,724 divided by 70,000 equals, let's just say 80%. Okay, so this is an example of where we have to go through each step. Now, 4 isn't applicable because we don't have any information if it's a highly specialized piece of equipment, but we hit the lease criteria, the finance lease criteria based on this. Okay. Now, as a result, we still got to figure out what the present value of all our payments are going to be. Okay, because that's going to set up our lease liability. Okay, so from there, Part 4 asks for prepare a lease liability amortization table only for the first 4 payments. Okay, so what I'm going to do then is I'm going to erase this and create a table. Again, we need to use 55,724. So if we're going to make our first journal entry to record the inception of the lease, it's debits, Are we leasing equipment? Yeah. Okay, so it's a truck. So debit truck under finance lease, credit lease liability, $55,724. Now, from there, what we need to do is we need to create our table, okay? Our amortization table. Okay, so we have our payment period, okay, 02, 03, 04, 05. Now, from there we have our opening balance. $55,724. Now this is on the first of the year. Okay, April 1. Now does it say what their calendar year is? No. Or what their fiscal year is? No. So we'll just assume it's year ended December 31st. Okay. Now that complicates things with the interest, but let's just ignore that for now. Okay, again, a good example is in the textbook. Now we have our interest payment. Okay. Now, again, this is in, I've given you the answer. We have our cash payment is always going to be 11.3. Now, we also need to make a column for the decrease in the principal. Okay. In this case, it's 11.3 as well, because that first year there's no interest. And then our remaining balance. So 55,724 minus 11.3, 44,424. Again, no interest in that first year. Okay. Now what? Well, our ending balance becomes our opening balance for 03. Okay. What's our interest going to be? 7% times 44,424 is 3,110. Okay, so our cash payment is 11,300. The interest portion is 3,110. The difference has to be the decrease in our principal, okay, or the decrease in the loan liability. So that's 8,190. Giving us an ending balance of 36,234. Okay. I mean, now we can just go ahead and make our journal entries. Okay. So we're going to want to do a couple things. We're going to want to record the opening purchase again, and all these now are just, we can just follow the template on page 1256. Okay. So we're going to set up the lease liability. April 1st, debit asset under finance lease, 55,424, credit the lease liability. Okay. Now, when do we make our first payment? In this case here, we make our first payment April 4th. So we get, again, at the beginning of the year. Okay, so then we'll debit lease liability, credit cash. That accounts for this payment here. Now, at the end of the year, okay, now we got to figure out, okay, well, how much interest are we using? Now, 7% times 44,424 is 3,110, okay? So if August 1st was if April 1st was the beginning of the year, and it said nothing about December 31st, we wouldn't have had to take a partial interest payment, okay? We just would have went straight to the end of the year, recorded our lease expense, okay? The credit would have went to lease liability, okay? Again, I'm just going off page 1256. We would have recorded our depreciation, okay? In this case, the depreciation is going to be 55,724 divided by 9 years, okay? Now, there is a residual value. So I made a mistake. 55,724 minus $5,000, okay? Because you don't include the residual value in your calculation, okay? So we would, 55,000 divided by 9 years would be our amortization, okay? And again, you just got to follow down the line. Again, just like that example on page 12. $12.55, $12.56, and $12.57. Again, you're just going to chip away at this ending balance. Okay. Now, let's go to the next topic, which is the sale and leaseback. This is on page, well, first of all, it's slide 40. Okay. So, and again, we're going to be on page 1268. So, a sale and leaseback is different, slightly different than a lease. So with a lease, we go and lease a piece of equipment or a truck or a vehicle or a car, whatever. We never owned it in the first place. We never did. We just went out and I said, we're gonna enter into a lease. A sale and leaseback is slightly different, okay? But kind of the same. So a sale is, we own an asset, we sell it to another party, and immediately that party turns around and leases it back to us. So we make a sale. Once we make that sale, we record the sale on our books. Then we just go record that lease as an asset because again, we're now going to lease it back. Okay, so usually this happens with a building. Okay, so we're converting. It's a transaction where a company sells the asset and simultaneously leases it back. Why? Well, immediately you get a cash flow, an incoming cash flow. Maybe the company couldn't get any money from a bank. They didn't want to sell shares. They couldn't issue bonds. So we have a $2 million building that we own. We're going to sell it to Mr. X. Immediately, Mr. X is going to come back and lease it to us, okay? So let's look at the example in the textbook. Page 1269. Again, so what's happened, it just freed up a lot of cash for us. Maybe we could use it for something else. Okay? Maybe we're in dire straits. If we don't get that additional money, then we are gonna have to claim bankruptcy and shut the doors. Okay? So, if we look at our example, page 1269. Okay? Vendor owns a building in central Montreal. They enter into a sale and leaseback agreement. The original cost of the building was $10,000, 60% depreciated. So as a result, the net book value on that building is $4 million. Okay. The event Ballard agrees to pay $8 million for the building, which was fair market value at the time. Ballard agrees to lease the building to vendor for 20 years. Annual lease payment $850 payable at the end of the year. No guaranteed residual value. Vendor will pay all the building's operating and maintenance costs. Okay, but that's not even included in the payment, so that doesn't matter. Date of the agreement is January 1st. The incremental borrowing rate's 9%. Ballard's interest rate implicit in the lease is computed after tax and not disclosed, so we're just going to use 9%. And vendor uses the straight line depreciation for buildings with a full year of depreciation in the year of acquisition. Okay, so first of all, we'll do our calculations. There's no bargain purchase option. Useful life, well, the useful life, what is it? Do we even know? 20 years on a building, the building could last 100 years. So let's just say it's 20%. So we don't get number one, we don't get number two. Now, maybe the present value of the lease payments is at least 90% of the fair market value. Now, in this case, it is, okay? They already do that calculation for us. But the present value of the lease payments is $7,759,264, which is 90% more than the sales price of the building. So that is, as a result, we get to classify this as an asset under a finance lease. So the first journal entry we're going to do is, again, we can see it from the textbook. Okay, we sold the building for cash of $8,500. So $8,500 in cash came in. Now, we got to take the building off our books, right? Credit building $10,000, credit accumulated depreciation on the building $6 million. Sorry, did I say 10,000? It's 10 million. Okay, so the building is a credit of 10 million. The accumulated depreciation is a debit of 6 million. What's left? A credit of 4.5 million to balance out that journal entry. Okay, well, is it a gain? Looks like it's a gain, but we have to defer that gain, okay, over the entirety of the lease. So 4.5 million divided by 20 is $225,000 per year. So we're going to record a gain every year of $225,000. Debit deferred gain on sale and lease back of building, $225,000. Credit gain on sale of building, $225,000. Okay, so that records the deferral. We're going to do that 20 times. Now, what about the lease? Okay, so let's go to page 1270. Again, we had to figure out the present value of that lease to determine is it an operating lease or a finance lease. We figured out it's a finance lease. So debit building under finance lease, $7,759,264. Credit the lease liability. Now at the end, now that was on January 1st. At the end of the year, we're going to do two entries. Okay, we're going to record the interest expense, debit interest expense, credit lease liability, 9% times the opening value, okay, or opening balance. So that gives us $698,334. So debit interest expense, credit lease liability. Now, at the same time we make that entry, right after that we make another entry because we've got to record our cash payment. Debit lease liability, credit cash. Okay. We also have to record the accumulated depreciation. Okay. So in this case here, vendor uses straight line. Since the 20 years, the straight line is 5% a year. Okay, so I want to see what number they're using. 7,759,264 divided by 20. 387,963. So before I said, well, if there's a residual value, we can't include it. We don't want to include it, but is there a residual value? No, there's not. So again, we're just going to use the full cost of the building or the whatever we put it on the books at. Okay. Again, if there was a residual value, we would back it out and amortize the building based on whatever the net depreciable amount would have been. Okay. And then furthermore, we're going to record the gain. Okay. The deferral. So debit gain on sale of lease back of building, $225,000. And in this case here, I was going to just go credit gain. Ultimately, it ends up being the same thing because we're reducing our depreciation expense for the year. Okay, but they credit depreciation expense lease building $225,000. So we're actually reducing the depreciation amount. Okay, so you would do that on a yearly basis for 20 years. Okay, the only difference being is your interest expense, okay, will be reduced because the lease liability is getting reduced. Okay, so that's just a little review on leases. Again, an equipment lease, determining is it an operating lease or a finance lease, and then the topic of sale and leaseback arrangements. Okay, we will talk to you tomorrow. Try a couple of the questions that I've assigned, and we'll see how that works out on Thursday.